Okay, now we're going to look at another differential analysis part of the chapter. We're going to look at whether to replace equipment, and then we're going to look at a process or sell. This is chapter 24, Managerial Accounting, page 1215 to 1217. And we're going to look at brief exercises 24-4 and 24-5 on page 12. Actually, I got that wrong. 1243, not 1242. Okay. So it's not uncommon for companies to need to replace equipment on a regular basis, but we have to look at whether there's value in replacing that equipment. This could be anything from value in our processes of speeding up, how well the machine works, whether it manufactures product at a greater rate or is easier, more efficient, or safer, down to whether it's cost valuable for us to do it. And that's more like what we're looking at in this case, because it's an accounting class. But there's more than just that goes into a decision like this. So the usefulness of a fixed asset always decreases over its life. Easiest example of this, think about a computer. The day you get it, you think it's as fast and works great and everything's perfect. And then you're into year 2 and 3 and 4 and you're thinking, I just want to throw this thing against the wall because it doesn't work anymore. Well, its usefulness just diminishes over its life. And the same thing goes for almost any piece of equipment, truthfully. Not only its value, but its usefulness. And usefulness is really what we care about when we talk about depreciation anyways. We want to look at, okay, if I'm thinking about buying a new machine versus what I currently have, but remember, we're taking out sunk costs because that doesn't really matter. We're more looking at future costs, and we're looking at things that vary between my decisions. And then we're also going to look at opportunity costs. Real quick, I want to define that for you before we go through the example in the book. On page 1216, it says that time value, money, and other uses for cash needed to purchase the new equipment could also affect the decision to replace equipment. Revenue that is foregone from an alternative use of an asset, such as cash, is called an opportunity cost. Although most opportunity cost is not reported in the accounting records, it is useful in analyzing alternative courses of action. So what did I give up in order to get whatever it is that I'm doing? Okay, that's what an opportunity cost is effectively, whether that is using my cash for something else or anything else. Okay. So going through the illustration on 1215, it says, assume on November 28th of the current year, the business is considering replacing an old machine with a new machine. The old machine, we have the book value of $100,000, the estimated annual variable manufacturing cost of $225,000, estimated selling price of $25,000, and the estimated remaining useful life of 5 years. They could purchase a new piece of equipment for $250,000. The annual variable manufacturing cost of this is $150,000. The estimated residual value currently is 0, and the useful life is 5 years. So when we look at the relevant issues here, continuing with the old machine has no revenues because we're talking about whether to invest, but there is actually revenue on replacing the old machine because we would sell it for cash and gain some money in that regard. Continuing with the old machine, obviously we would have no purchase price, but we would have $250,000 difference on the replacing of the old machine because we're buying it for $250,000. Continuing with the old machine has a lot more variable manufacturing costs, $1,125,000 versus $750,000 for the new one. So when we look at the differential here, when we go and look between my income and loss in total, we would want to choose alternative 2 because it costs us $150,000 less to buy that new piece of equipment, mainly stemming from the variable manufacturing cost differential. And that one we'll look at 24-4 on page 1243 here in just a minute. You can go back and do it now if you want to freshen in your mind, 24-4. And then I'm going to go through process or sell, and then I'll go through both of the problems at the end of the video. So process or sell. Also very common in manufacturing when we are, especially for making either a food product or something that is utilized in a lot of different areas. So let's say I produce apples. Okay, well, I could produce apples in their raw form, just apples. I could produce apple slices that are, sold to restaurants or sold in stores as sliced up apples on fruit trays. I could process it further to make apple juice, or I could so on and so forth. So there's all these different things that you can do with that apple. How do you make the decision whether you want to do apples, apple slices, or apple juice? Another example, oil is used in a lot of things. We know it's used in gasoline, but it also can be used in plastics and other materials. At what point is it worth me as an oil processing plant? At what point is it worth it for me to stop? Because generally what you're talking about is the further along it goes in the process, most often the further along that it goes in the process, two things happen. Number one, there's additional costs. Because if I stop, so for example, apples, if I stop at just an apple, then I'm just literally picking apples, making sure they're clean, bagging them up and shipping them out. That's all there is to it, right? Done. If I'm slicing them, well, now I'm not only gathering and doing everything I did before, but also I'm putting through a process of some kind to get them sliced and get them bagged or packaged in some way. So there's additional cost there. The other thing that typically happens is usually the selling price goes up. Every time I process it further, the selling price goes up. So where the complexity or the difficulty of this particular part of the chapter comes in is the fact that I can't just look at what the revenue difference is. I can't just look at what the cost difference is. I got to do both the revenue and the cost differential, and see whether there's value in me processing it further or whether it's more valuable for me to sell it at a given point. So the example they have here to illustrate says that a business produces kerosene as an intermediate product. So they have kerosene, their batch sizes are 4,000 gallons. The cost of producing kerosene is $2,400 per batch at a selling price of $2.50 per gallon. Kerosene can be processed further to yield gasoline. Gasoline, notice that this goes down a lot. We put 4,000 gallons into the batch, but I lose 20% to evaporation through the process. So my output is only 3,200 gallons. This is important because otherwise I could almost simply compare for the revenue side anyways, I could just compare one to the other for my batch size and gallon price and then just be done. But the fact of the matter is I can't for two reasons. One is there's additional cost, and two is that I lost some gasoline to evaporation. So now if I do that, I have $3,050 worth of additional cost for producing gasoline. And by the way, that should be, I'm not doing this as an additional cost, we're doing this as the total cost for producing gasoline. And then the selling price is $3.50. So you can see our differential analysis. We bring in our revenues, and all we would do is take the gallons times the price per gallon. And then for the costs, we're given both of the costs in this case. So some problems will say, this one gave you the total cost, so it was kind of simple and straightforward. A lot of problems don't do that. Instead, they'll say it costs us an additional this dollar amount to process it further, in which case you want to make sure and add that to the additional cost of what it takes to process that further. So let's go back and look at 24.4 and 24.5. Go ahead and write my formulas in here. Let's go a little quicker. All I'm doing is writing my formulas, so when I type my numbers in, it'll just do it for me rather than having to go back and write them. But this is just some formulas. It's just subtracting this one from this one. Okay, so we have a machine with a book value of $80,000. And has an estimated useful 5-year life. A proposal is offered to sell the old machine for $50,500 and replace it with a new machine at a cost of $75,000. The new machine has a 5-year life with no residual value, and the new machine would reduce annual direct labor costs from $11,200 to $7,400. Prepare differential analysis dated April 11th as to whether to continue to use the old machine or replace the old machine. So revenues, if I replace the old machine or continue with the old machine, this is zero. But if I replace it, I receive $50,500 cash for selling it. Now, as far as my costs go, if I continue with the old machine, I'm not going to be buying anything, so there's no purchase price. If I buy the new machine, it's $75,000. Now the direct labor, I want to know the total over the 5-year life. So I have 11,200 times 5 years for the old machine. And for the new machine, I should have done this. 7,400 times 5 years. Maybe I can change this one. These need to be negative. Sorry. Those are costs. Okay, there we go. So the differential effect is $5,500 worth of a loss if I replace the old machine. So in this case, I'd want to continue with the old machine. $5,500 better to continue with the old machine. And that is all for this video.